Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So today we're doing a deep dive into two forces that, at first glance, they seem like they're in totally different worlds.
Completely different.
But they're both fundamentally shaping the AI economy right now, as we head into 2026. On one hand, you have the physical world, the slow, constrained world of silicon supply chains.
We're talking foundries, packaging, memory chips, the actual hardware.
Exactly. And on the other hand, you have the psychology of the market, the fast, sometimes illogical, and right now, very, very optimistic individual investor.
It's a perfect contrast, really. The analysis we're looking at covers everything from the tiny details of semiconductor markets, like memory pricing and capacity, all the way up to, investor psychology data and CEO surveys.
Right. So our mission today is to cut through that noise and find the real structural trends. First up, we need to uncover where some unexpected profits might be hiding in the hardware stack. Specifically, we're going to explore this idea that standard server memory, what we call DDR, could actually have higher profit margins for a while than the premium AI memory, HBM.
Which sounds completely backwards. And then for the second part, we pivot to the market itself. We're going to try to decode this relentless buy-the-dip mentality that retail investors have for AI stocks.
And what fragility that creates.
Exactly. What kind of systemic risk that introduces when the bigger institutional money starts to get a little bit nervous.
So it's the constraints of the physical world meeting the, boundless optimism of the market.
Okay, let's unpack this. Let's start with what feels like a total contradiction. Anytime you hear people talk about AI servers, all the focus is on high bandwidth memory HBM.
It's the star of the show.
It is. It's the key ingredient for the latest GPUs, the latest accelerators. So why on earth would any analysis predict that the profit margin on standard, commodity DRAM like DDR5 in a regular server could actually surpass the margin on HBM? Yeah, that prediction, it's based on some recent UBS modeling, looking at a company like Micron, and it's probably the biggest surprise in the memory sector right now.
And they're pointing to when? Sometime in 2026.
Sometime around the second quarter of the 2026 fiscal year, potentially. But here's the key. It isn't happening because HBM is in trouble. It's happening because HBM is, too successful.
Okay. Define those terms for us really quickly, just so we're all on the same page.
Sure. So HBM is the specialty stuff. It's memory that's stacked vertically, offering this insane bandwidth directly to the GPU. It's custom, it's complex, it's expensive.
And DDR?
DDR, specifically server DDR5, that's the standard workhorse memory. It populates the rest of the server rack and handles all the general computer operations. And the core reason for this potential margin flip is structural. It's all about capacity reallocation. The big memory makers, Samsung, SK Hynix, Micron, they all know HBM is the future. That's where the highest value is.
Right.
So they're aggressively shifting their factory capacity, their engineering resources, everything over to producing more HBM.
Wait, hold on. So you're saying the AI boom, which is fueled by HBM, is kind of eating its own tail by starving the rest of the market of standard memory?
That's a perfect way to put it. By prioritizing HBM, they structurally tighten the supply of standard DDR. It's a zero-sum game with existing factory lines. You can't just magically make more of both at the same time.
Okay, let's use that bakery analogy we talked about. I think it makes it really clear. Imagine you run a high-end bakery.
Okay.
Suddenly, demand for these insane custom wedding cakes, that's our HBM, it just explodes. They're your biggest profit driver.
Well, everyone wants one.
Exactly. So you dedicate all your best bakers, all your best oven time to making these incredible complicated cakes. But because of that, you are baking far fewer of your standard artisanal loaves of bread. That's our DDR.
Right.
The cake itself costs more, for sure. But because you've created this sudden extreme scarcity of basic bread, you can actually raise the price of that simple loaf faster and more dramatically than you could change the price on a wedding cake you promised to a client 3 months ago.
And that contract structure you just mentioned is the hidden financial key. HBM sales usually involve these long, complex contracts with huge customers like NVIDIA.
So the prices are locked in for a while.
They're locked in. The specs are locked in, the delivery schedules. It makes it really hard to just jack up the price overnight, even when demand is through the roof. Plus, the manufacturing cost for HBM is just very, very high.
But for standard server DDR, The pricing is much more flexible.
Much more. It's more of a commodity market. DDR5 prices can adjust way faster in a tight supply situation. So when the suppliers cut back production of the bread to focus on the wedding cakes, the shortage lets them raise prices almost immediately.
I see.
And that ability to react, that's what we call capacity leverage. The financial benefit flows straight to the DDR profit margins, and it happens fast.
That makes a lot of sense. So it's a short-term play based on scarcity,
Mm.
not some long-term shift in value. But what's really interesting to me is how this connects back to what some sources call the memory wall.
It absolutely strengthens it. I mean, when you look at AI accelerator shipments, whether it's the current top-tier H200s or what's coming next with Blackwell, they're constrained by two things.
The chip itself.
And the memory. But not just HBM, it's also the standard DDR you need to build the entire functioning server.
Ah, so the bottleneck isn't just the brain of the machine, it affects the whole nervous system.
Exactly right. When both HBM and DDR are tight, the total cost of materials for an AI server, it just skyrockets. And so does the delivery risk. Even a giant like NVIDIA is facing this huge logistical puzzle.
You see reports about it all the time.
You do. Reports talking about expanding H200 production, maybe because of, changing export rules from the administration. But even with overwhelming demand, the final number of units they can ship is still dictated by that critical choke point, memory and advanced packaging.
That's a huge insight. So the bottleneck isn't one component. It's the whole interconnected dance of getting two different types of memory made and packaged together.
And this is the strategic takeaway we really want you, the listener, to grasp. This potential margin flip doesn't mean HBM is unimportant. It actually proves the opposite.
How so?
AI demand is so powerful, it's making the entire memory market more valuable, but it's redistributing where the profit leverage shows up. You have to remember this simple equation. Memory plus packaging equals shipment volume. That's the hard ceiling on the AI supply chain through 2026.
That's a perfect pivot. Because while the physical supply chain is constrained by hard realities, the market's response is, well, constrained by pure belief.
Right.
We've established the physical scarcity. Now let's shift to the psychology. How are investors actually reacting to these sky-high valuations? So the second big thing we're seeing in the data is this persistent, really aggressive behavior from retail investors. Individual investors just keep buying the dip in the big AI stocks.
The NVIDIAs, the Palantir.
Yeah, all of them. Even with valuations that are, historically very, very high.
The confidence is honestly startling. We saw Motley Fool research from late last year where something like 2/3 of the people they asked were extremely confident in the long-term profits of AI stocks.
They see it as a permanent shift.
They see it as a fundamental engine for productivity, not just a bubble. And data from Investopedia confirms it. Heavy buying during those late November dips in the big names. Retail is all in.
Okay, but isn't that what you're supposed to do? Believe in the long-term structural growth. What's the hidden risk in that kind of optimism?
The risk isn't the belief in growth itself. It's the concentration of that belief and the lack of price sensitivity it creates.
What do you mean by that?
Well, if you keep buying every single sharp dip, especially when valuations are already high, you're constantly raising your average purchase price. We call this concentrated optimism.
So your break-even point just keeps going up.
Precisely. And when a real period of volatility hits, and it takes a lot longer to recover because your cost basis is so high, and because the AI sector tends to have these winner-take-all dynamics, all that risk is piled into just a handful of companies.
And this optimism is happening at the same time. There's this growing ambiguity on the corporate side.
Exactly. That's the other side of the coin. The signals for future AI spending are strong. A Wall Street Journal survey of CEOs showed a big majority, around 68%, plan to increase AI spending in 2026.
Okay, that sounds good.
It does, however, and this is the fragile part, fewer than half of those same CEOs are currently reporting that they're seeing a sufficient return on investment. The ROI isn't matching the cost yet.
So companies feel like they have to spend the money to keep up, but they can't quite prove yet that it's making them money. That sounds like a ticking clock for market expectations.
It creates this really interesting dynamic. The growth premium story continues because the spending seems mandatory. But that gap between the CapEx, the spending, and the immediate ROI creates a lot of fragility.
Because if the earnings don't show up,
If the earnings disappoint, or if CFOs start saying, hey, let's slow down, this is getting too expensive for the return, the market could re-rate those stocks very, very quickly.
and we're also seeing a split between the big institutional money and the retail money.
A very clear split. Vanda data shows retail net buys spike right after those sharp drops. They're the ones holding the line in the short term. But Reuters reported that U.S. stock fund inflows, which is more institutional money, slowed to a 4-week low back in mid-November.
The big money is getting cautious.
It is. When institutional money, the funds that really move the market, when they slow down because of valuation concerns, the top of the market gets what we call heavy.
They're not willing to push prices any higher.
Right. And now, if we get what's called a reconfirmation event,
Wait, reconfirmation event. What do you mean by that in this context?
it's just a milestone, a scheduled moment where the market has to ask itself if the high valuation is still justified. Think a disappointing quarterly earnings report, or a change in guidance, maybe a delay in a new chip.
Got it.
So if the institutional money is already on the sidelines, and then one of those disappointments happens, the clash between their caution and retail's conviction could amplify the drop incredibly fast.
Okay, so let's use that tug-of-war analogy. You have retail investors on one side, full of conviction, pulling hard. They are the buy the dip crowd.
Right.
On the other side is the institutional money. But they've stopped pulling. They're digging their heels in because of the high valuations and that murky ROI picture.
And if the ground underneath them, say, that disappointing earnings report shifts even a little bit, the tension on that rope could just snap.
And the price falls much faster than anyone expects.
Exactly. And the retail buyers find themselves holding shares they bought on a dip that turned out to be the start of something much bigger. That's the shift investors need to be ready for. And to really connect to these two big themes, the hardware chain and investor psychology, we have to go back to the cost issue. That cost escalation we talked about in memory and packaging that directly contributes to a higher total cost of ownership, or TCO, for building AI data centers.
It's getting more expensive to play the game.
Much more. Now, if the big hyperscalers just absorb that cost and keep spending, the AI cycle keeps rolling. But if the costs get too high and they can't pass them on to their customers, especially for services that are slow to make money,
Like a lot of generative AI apps,
then the speed of their investment could slow down. A lot.
which puts all the pressure right back on those valuation expectations we were just talking about.
That's the link. And it leads us to a key investment framework. We think you should stop looking at AI as just one single thing.
How should you look at it?
Strategically, you should divide your assets into two buckets. First, you have your growth assets, that's HBM, cutting-edge AI software, things with huge long-term potential.
And the second bucket.
The second is leverage assets. These are the structurally tight commodity parts, like standard DDR, where supply constraints create massive short-term profit leverage.
So if you only own the growth side.
If you only own the growth side, you risk missing out on the short-term profits dictated by the supply chain. And you're fully exposed to the volatility if institutional money gets cold feet.
But if I own both, am I not just sort of hedging? Am I missing out on the really big wins?
It's more strategic than just hedging. It acknowledges the reality of the physical world. The growth assets are a bet on future earnings potential, but the leverage assets capture profit today based on proven, immediate scarcity. Owning both insulates you from these sudden structural shifts like the DDR margin flip we discussed. It lets you capture the whole cycle.
That's a really powerful distinction. So the essential lesson here for you, the listener, is to really track the speed of monetization across this whole value chain. We know from the CEO surveys that short-term ROI is a big question mark.
A huge question mark.
So the question you need to be asking yourself is this: are you invested in infrastructure? The chip makers, the memory providers, where the demand is captured immediately by those big CapEx budgets? Or are you invested in the services and apps where real profitability might be much further down the road? And which of those segments is more vulnerable if that buy-the-dip mentality, which is based on promises of the future, finally breaks? Understanding where the money's actually being made right now versus where people just believe it will be made. That could be the critical edge. Don't forget to subscribe and hit that like button.